Hello everyone, and welcome. Today we'll be exploring one of the most important concepts in finance, risk and return. Every investment decision comes with a trade-off. The potential for reward is always tied to the possibility of risk. Risk represents the uncertainty of outcomes, whether it's market volatility, economic shifts, or company performance, while return, essentially the reward, measures the gain or loss an investor receives from their choices. Understanding this relationship is crucial, because higher risks often carry the potential for higher rewards, but they also expose investors to greater chances of loss. For example, picture two friends. One puts their money in a savings account. There's almost no chance of losing money, but the interest earned is small, so the growth is slow. This represents low risk, low return. The other friend chooses to invest in stocks. Stock prices can go up or down, and there's a possibility of losing money in the short term. However, over time, stocks have the potential to grow much faster than a savings account. This represents higher risk, higher return. The idea is that to earn bigger rewards, you usually have to accept more uncertainty. That balance between how much risk you're willing to take and how much return you hope to earn is known as the risk-return trade-off. In finance, the risk-return trade-off explains that higher returns are only possible when we take on higher levels of risk. This idea guides companies and investors in making smart financial decisions. For a business, it helps determine whether to invest in a new project, take on debt, or expand operations. The goal isn't to avoid risk completely, because without risk, there is little growth. Instead, it's about understanding the risks, measuring them carefully, and managing them strategically to achieve the best possible return. Consider a company choosing between two projects. Project A is safe, offering a steady 5% return, while Project B is riskier but could yield 15%. Finance teams use tools like expected value and beta to evaluate which option fits their goals. For a risk-averse company, Project A provides stability and predictable cash flow. For one willing to accept volatility in pursuit of higher growth, Project B may be the smarter choice. In the end, the decision highlights the balance between risk and reward, and how each organization defines success. To succeed in corporate finance, you need to understand how risk and return interact. Risk is uncertainty. Return is the reward. The higher the risk, the higher the potential return, but not every risk is worth it. Think of it like climbing a mountain. The steeper the climb, the better the view. But smart finance means choosing the right peak. We balance risk and return using data, strategy, and clear goals. Tools like scenario analysis and risk-adjusted metrics help us see the terrain. Managing risk isn't about avoiding it, it's about aligning it with the value we want to create. Before we end, the best outcomes come from analyzing options, comparing possibilities, and choosing what aligns with your goals. If this topic interests you, keep exploring concepts like diversification, expected return, and the risk-return trade-off. The more you learn, the more confident your financial decisions will become. Now, it has come to the end of our video. Thank you for watching.